sick, so we'll see what we can do. So I brought, for nostalgia's sake, the textbook, just because we know we're not covering. Let's just remind ourselves that the exam is next week, week 14. I'll be around all week, so if you get stuck or you have any questions, make sure you get in touch with me sooner rather than later, so we can put everything to bed. In terms of material, hopefully at this stage everyone is somewhat comfortable. When you look through again the first 4 chapters of this book, chapter 1, just to remind ourselves, just a very brief overview of what is a trust, what is an estate. Chapter 2 talks about characteristics common to trust and estates, and just like any other taxpayer, or at least put it this way, similar to other taxpayers. And then what we did is we spent quite a bit of time looking at chapter 3. Chapter 3 deals with what is income versus a bequest. This is a refresher from your income tax course, 102A, if you recall. And then we spent quite a bit of time looking at this concept of D&I, code section 643, because you really can't master subchapter J without a very good understanding of what is D&I. And just remind ourselves on Schedule B of Form 1041, there's a lot of in-depth discussion of D&I, or all the complicated statutory language and regulatory language is distilled down to a few lines on Schedule B, the 1041. Next is a discussion in Chapter 3 about distributions to beneficiaries, and we looked at distributions both from the perspective of simple trusts, complex trusts, and estates. And we saw the operative code sections be code sections 651 and 661 in terms of deductions, and then inclusion issues 652 and 662 in terms of inclusion. And we saw that there's designed to be at least theoretically symmetry, that whatever the trust or estate deducts, the beneficiaries will have inclusion. So remember that this, a fair amount of the concept of subchapter J is intertwined with the assignment of income. Who is taxed, right? Not a question of who gets taxed, not a question of how much, not a question of character, but who gets taxed on the income, whether it be the beneficiary or the entity. And then in chapter 4, we looked more closely at this concept of the entity ignored. And we looked at code section 671, and 671 says that if certain definitions are met, and it constitutes a so-called grantor trust, the trust does not have to follow the parameters of subchapter J. Instead, to the extent it is a grantor trust, remember, it can be a grantor trust as to a portion. So a portion could be a grantor trust, and the other portion may be subject to the normal rules of subchapter J. But if the entire trust is considered a grantor trust, well, then indeed, you can just file 1041 as an informational return. That's it. We said that grantor trusts are very common, one particular form. That one particular form might be what kind of trust? Just to refresh your memory. The most popular grantor trust is revocable, right? Everybody agree? A revocable trust is fairly common in many parts of the country. Not so much in New Jersey or New York, but there is quite a few people out there who do have revocable trusts. And like I said, on many occasions I've set up revocable trusts, not to avoid probate, but for reasons of privacy or to avoid ancillary jurisdiction. But certain states, including, by the way, I learned Connecticut is a state where you don't want to have probate. People in Connecticut, I now know Florida, California, and at least Connecticut are 3 states where revocable trusts are very popular. But we studied Code Section 671, talks about the implications. Code Section 672 offers definitions of what is an adverse or non-adverse party. And then there's several code sections, 673, 674, 675, 676, 677, that describe what is a grantor trust. We said Code Section 678, I don't know if anyone mentioned it over the Thanksgiving dinner table, but those are known as Mellencrot trusts. I know a lot of people would have thought, what were you smoking before Thanksgiving if you were name dropping Mellencrot trust? But why did it get the moniker Mellencrot Trust? They got the name they got that moniker, not surprisingly, because there is the famous Mellencrot case that if the beneficiary has sufficient indicia of ownership over a trust, if the beneficiary has sufficient indicia of ownership, that the beneficiary, not the grantor, gets taxed, right? So Code Section 678, if the beneficiary has certain, for example, rights of withdrawal, the beneficiary is deemed taxable, right? And believe it or not, people really do, and this is what I can tell you. I have heard people talk about, oh, it's a Mellencrot trust. I really have. Maybe I hang out in the wrong circles, no doubt, but it is noticed because of Code Section 678. All right, so we looked at the grantor trust rules, and again, half the battle or 9/10 of the battle when it comes to grantor trust rules are to simply identify what is the grantor trust. Because once you do the identification, the rest is fairly straightforward. All right? But getting to Ming's point, if you're dealing with a revocable trust, that's not a portion. That's the entirety of the trust is treated as a grantor trust. And not surprisingly, that's pretty close to ownership, right? And just again, to make sure people know, because periodically you will hear people talk about Clifford trusts, okay? And just know that Clifford trusts have gone the way of the dodo bird, that they don't exist anymore because well, Congress has changed Code Section 673 so that if your reversionary interest is greater than 5%, which is a very low threshold, it's going to be treated as a grantor trust. And yesteryear, again, statutorily, Congress gave a pass to people and said as long as it exceeded 10 years, that it would be ignored for subchapter J purposes. All right, so anything regarding, before I put the book down, anything regarding the book that you guys wanted to, again, I will be carrying this around, okay, all the rest this week, next week, I will be carrying this around. So if you do get stuck and there's a problem, please let me know, because
can I ask a question?
you can ask anything.
In the case where the trust pays for the life insurance premiums of the grantor,
Okay. Can I ask you a question?
Yes.
Can I interject? What kind of trust is that typically referred to? What would you call that trust over the Thanksgiving dinner table?
grantor?
Well, a life insurance trust, but what name does it typically go by? This, because you guys, when you leave this class, I want people to know labels are important. And in practice, what do most people refer life insurance trusts? They're not revocable. 99% of trusts are irrevocable that hold life insurance to keep it outside the estate, right?
So they're not grantor trusts.
Well, they are to the extent they're used to pay premiums, right? But They go by the name of crummy trust, right? Right, crummy trust. And then why do they get the moniker crummy? Crummy v. Commissioner. And what is the piece de la resistance of crummy trust? What provision does a crummy trust have in it that makes it a crummy trust?
Beneficiaries they have to be advised that they can pull the money.
They have a window period of withdrawal.
Yes, 30 days.
And what is the purpose of the window period to withdraw?
Avoiding tax.
To take what otherwise is a future interest under Code Section 2503B and make it into a present interest. So it qualifies for the so-called annual gift tax exclusion, which is currently how much per year?
11.
15.
Does that go out next year?
I don't think it does. To my knowledge, it is not, even with inflation adjustments, it hasn't reached the next
Oh,
threshold.
gift tax, not
It's for gift tax. No one's dead. So I'm sorry, that was me just having fun, so keep
No,
going.
no, sure. Okay, so the trust, or the crummy trust, or whatever, the life insurance trust pays the premiums.
Well, the crummy trust.
Okay, pays the premiums for the grantor. Do they deduct the premiums?
No. Here's the game. Your husband gets $1 million policy on himself, okay?
Okay,
He sets up a crummy trust, he names you as the trustee, and the premiums on his life for the $1 million policy are $15,000 per year. So
That's
he
a lot.
contributes the $15,000 to the trust. You put it in your TD savings account under the trust ID number. You wait 30 days. After 30 days, you cut a check to the insurance company. And typically, I advise people to have it in a non-interest bearing checking account so the trust never even has to file a 1041.
so
Does
no
that
one
answer
gets
your
any
question?
tax benefits?
What? The tax benefit is your husband dies, it's not includable in his gross estate. And upon your demise, it's not includable in your estate because it's an irrevocable trust. It's not being done for income tax purposes. And recall from our first class, people are not setting up these trusts to save income tax, right, guys? John?
You said hold it there for 30 days. Is there a reason for that?
Yeah, because you want to make sure, the terms of the trust specifically say, pursuant to the crummy case, you're supposed to hold a window period so that future interest, there's a window period of the beneficiary to withdraw.
Does it have to be 30 days?
No, there's case law that says 15 days, and some people will even say, and I've seen plenty of people, like V's husband, who writes it directly to the insurance company, and they just say, look, yeah, assuming that the policy is not a term policy, it's a whole life and there's cash value, hey, they could have withdrawn the cash value.
Okay, so I'm saying I do that a whole lot of work, you know, generally have that.
I wouldn't put that in writing. I mean, I'm just saying some clients just don't want to spin wheels, so they don't do it. But you as the practitioner have to be more careful. And when clients tell you not to worry, be worried, okay?
I know, we, as a firm, we are supposed to send a letter to beneficiaries saying you have 30
Right, that's a crummy
days.
notice.
Yeah.
Yeah. So I'm just saying, John, clients can do what they may, but you don't want to be the one.
Does it matter? Do they have unlimited skifting between each other?
Well, no, because when V's husband is making the contribution, he's not making it to V directly, so it doesn't qualify for the marital exclusion,
Gotcha.
right? So that doesn't cut it.
So the point of this is in case, I mean, the whole point of doing this is that you think you're gonna end up with an estate large enough to be taxed.
Absolutely.
Okay,
You want to do it otherwise,
okay.
all right? And that's why they were much more popular when the estate tax exemption was $600,000 than where it is today, right? All right, so let's turn to this charitable trust, and let me just summarize some of the things we covered 2 weeks ago. Some of you were here, some of you unfortunately couldn't be here, but hopefully those who couldn't be here, compliments of me, could see the videotape. So hopefully you caught the videotape on this. I will give you the quick story that I did get this. I moderated in New Orleans the night of I went to New Orleans, and I was successful. And I walked around that Thursday was the day I moderated, and I thought, excuse me, yes, that Thursday was the day I flew down Wednesday, moderated Thursday, and I thought, gee, I am lucky. Why am I so lucky? Because my plane flight on Friday is at 6 in the morning, and I land in Newark at 10 in the morning, and by then the storm will be long gone, the storm that everyone in this room experienced. Well, I'm walking around the whole day with a big smile on my face, and everyone else's flight is being canceled, and I'm saying, gee, I'm the luckiest guy walking around. Well, do you want to write the rest of the script? Is 8:30 that night, right before I'm like ready to do a long day, I get a text, your flight's been canceled. And needless to say, at 8:30, everyone's flight had been already, they had rebooked. So when I went online to rebook my flight, when was the next available? This is Thursday night. The next available flight was Sunday night.
Oh.
That is not good for Jay Sullivan, okay? Because I was ready to put on my own set of wings, possibly fly, rent a car, and drive from Louisiana to New Jersey. It's just, that was not in my comfort zone. And there was literally no plane flights to Philadelphia, LaGuardia, Newark for the next 3 days. I checked, there was 0. So when you're in desperate mode, what do? You think out of the box. I got the last available flight going 6 in the morning the next day to Chicago. From Chicago, I then flew to Washington, D.C. And from Washington, D.C., I got the last available train ticket to Newark. And then from Newark, I took the shuttle bus back to the airport. So started at 3 in the morning that day, ended at 9, but I did get home. So that's what we call determination. I would have driven it if I didn't get that last ticket, but everyone got home safely that Thursday night. I hear some harrowing stories of people's 20-minute commutes becoming
3 hours.
Couple hours.
Yeah, downstairs neighbor's house, there's a 7-minute normal commute, 7 hours to get home.
Oh, wow.
Yeah,
All she had to do was cross I-80, couldn't cross I-80.
I heard all sorts of stories that came to
Yeah,
this.
my mother left from Wolsey Street here in Newark. A normal 30-minute drive to East Hanover. She left at 2 p.m., got home at 2 in the morning almost.
Wow.
Yeah,
Oh,
almost
wow.
a 12-hour drive. My
And-
father actually had to meet her on 280 because she was running out of gas. So
There
he,
were so many
got her
disabled
home,
cars on
200 cars,
280.
yeah, over
Because
200
we
cars.
went to that conference the next morning, and as I was driving on 280 to East Hanover, the conference was there. There were disabled cars left, right, everywhere on 280.
My uncle the next
So,
morning said that 280
crazy.
it looked like a zombie movie. There was just cars left
Yeah.
on the highways.
I thought they closed 280.
They
did
did.
that,
They actually closed 280, 80, and I think one of the tunnels to the city were completely shut down that day.
Yeah, in retrospect, maybe it was a good thing I was in New Orleans, because I am kind of a sicko when it comes to work. I'm thinking, oh, I can handle anything. And I would have been one of those people on the side of the road at 280. So I was pretty fortunate I wasn't around.
I had no problem, I was super.
Right. But you can have that, but no one else might, so that's a problem.
And that was after doing a double barrel whiskey tasting in the city for 2 hours, and then but I took the train first.
All right. Let's talk about charitable trust. And as long as we can hold it together when we talk about the acronyms, we'll be okay here. Because, again, over the Thanksgiving dinner table, you can name drop a lot of different of these acronyms regarding charitable trust. We know they come in 2 major flavors, right, guys? John, those 2 flavors are? I don't know. Liddy, do you have an idea? Not sure? PJ?
Credit and curve.
Well, just forget about the acronym. Just what kind of trust? Young Ho?
Charitable remainder unit trust, charitable remainder.
Well, I've been higher up.
Remainder and lead.
Remainder and lead, right? You're going down one level. Let's go with the highest level, right, Simone? Remainder or lead, right? Those are the two biggies. And the remainder, right? And these names speak volumes. The remainder trusts are trusts that vest charitable remainder trust, right? With the charity at the end, right? Conversely, charitable lead trust, hence its name, it leads off with the charity, right? So, again, some of these concepts, guys, I'm not going to say you're going to remember all the particulars, but some of the bigger takeaways you should remember a day, a week, a month, a year, 10 years from now, that charitable trust. And remember, after 1969, Congress, you don't have the luxury, if you want to qualify for tax purposes for charitable deductions or things like that, you can't just come up with your own format. Someone just yesterday sent me, someone sent me a will, and they said, oh, I'm a lawyer, I have to do a will for my brother, do you mind if you look it over and can you sign off on it? And I said, well, I always don't want to say, you don't want to say no to anyone, but I looked at this, and it said, and I'm not making this up, this part, I'm paraphrasing, not word for word, but essentially, there's two things. First of all, the terms of the will left it to a charitable foundation for the executor to decide for 2 years. After the 2 years, it was to be left to the guy who was the brother who was calling me up. So in other words, the person who wanted to do the will had multiple brothers, but the brother who wanted me to give the okay was the one who drafted it. Oh, coincidentally, he was the one who was going to get the bulk of the will, and he had some obscure provision that it was to be used for charity for X period of time, and then to go to him, as if that was going to cleanse things. But it wasn't a charitable remainder trust or charitable lead trust. It was sort of like, oh, this amorphous trust for charity. That doesn't cut it, guys, right? What do we know? If your client wants to set up one of these trusts, is this something you just say again?
Follow the IRS
Yeah,
samples.
follow the IRS pro formas, right? This is not your time in life to be creative. There's times in life you're supposed to be creative. This is not one of them, okay? So there are pro formas, all right? Why get creative here? You will not get a medal, okay? You will not get any sort of Congressional Medal of Honor, Presidential Medal of Honor. There are no medals here. The only thing you can get, in trouble, okay? So, if you can, try to stick to the models, okay? Now, we said there's two global kind of trusts here, charitable remainder trust, charitable lead trust, and then, Simone, you want to fill in the blanks? Each one has two flavors. Essentially, what are those two flavors? Subsets of each?
So the remainder trust has cracked and crut.
Crats and cruts, okay? And what is a crat? What is a crut?
The cracked, you pay a fixed amount to a beneficiary.
I fix them out and just put it in jargon. What's the right jargon? What's that fixed amount called?
Is it an
An annuity, right? A fixed annuity. Every year it's paid to the beneficiary, right? No matter what the investment returns are, a fixed dollar amount gets paid to the beneficiary year in, year out, right?
And then the remainder pays a fixed percentage amount to
You mean the uni trust?
the unit trust, yes.
They say what?
A fixed percentage.
A fixed percentage, right? So we have fixed percentage, and it can be for a term of years up to 20 years or life. It has to have a present value. The remainder interest must equal at least 10% with respect to charitable trust. With a charitable remainder annuity trust, you can't contribute, make any additional contributions with a charitable remainder uni trust, you can, during the term of the trust, make additional contributions. Now, so we have remainder trust, we have lead trust, and what kind of lead trust, Justin, I don't know if you recall, you saw the tape, do you recall what kind of lead trusts are there?
I'm behind right now.
They're behind Dave.
There's claps and clubs for charitable lead
Clubs and clubs, which stand for,
annuity and youth trust.
okay? Same thing where the charity, right, is the upfront interest, right? And it gets the charity gets a fixed annuity amount or fixed percentage. And then at the back end, there's a non-charitable beneficiary. So that's looking at the second layer. Is there even more refinement, Shane, with respect to one of these kinds of trusts? There's even more acronyms waiting.
Yeah, there's what types of,
Right, there's 4 different types of CRUDs, right? Okay, and what I hope will be our book at some point. This is like I said, this is slower than I would like, but with respect to the on page 2 and 3 spells out the different kinds of CRUDs that you can have, right? Standard, you can have net income, okay? You can have a net income with a makeup provision. And the next page, you can have a so-called flip. Right? Flip charitable remainder unit trust.
Okay. I just told him not to use this door. I didn't want to have to get up again. So I told him don't come back through this door.
I think the other door has, oh, okay.
It's being failed over here.
Gotcha. All right. So we have these different, again, labels are important. Hopefully you guys can label each of these trusts appropriately. All right. And then how is the trust taxed? How are the beneficiaries taxed? Well, the trust, unless it has so-called UBIT, unrelated business income, it is not taxed, okay? So charitable trusts are not subject to the ordinary rules of subchapter J. But the beneficiaries have this 4-tiered system, right? And the 4 tiers are tier 1, tier 2, tier 3. These are spelled out on page 4 of what I hope will be the textbook at some point. 4 different tiers, and there offer several different examples, and we went through several different examples. In other words, when beneficiaries get distributions from a charitable remainder, annuity trust, or uni trust, they are subject to tax, right? They are subject to tax. Right? And we spell that out on page 7, and we talked about, we've gone through that. So no one, your client should not think to themselves, gee, I'll make this contribution and then get tax-free income. That's not going to happen. Not going to happen. And we said that with at least remainder trust, that the person making the contribution can get a charitable deduction equal to the actuarial value of the remainder interest. So I'll repeat that with remainder trust, the contributor can get a charitable deduction with respect to the remainder interest. So again, there's, for exam purposes, just try to keep it simple. Be able to identify these and be familiar with the tier system. Anyone have any questions, Simone, regarding charitable remainder trust? And Simone, can I just make one more observation? That in my experience, and I think I speak for the accounting and legal systems in this country, that 99% of trusts created in the charitable area are remainder trusts, not lead trusts. So if you're gonna get this across your desk, chances are you're gonna have dealing with remainder trust, not lead trust. Just know that in advance. Simone.
So I just want to clarify 2 points. The first one was, a charitable trust cannot be taxed unless it has imputed income, but the distributions to the beneficiary are taxed. I just wanted to
Are
clarify.
taxed subject to the tier system.
Okay.
So let's just be careful, Simone, for language purposes, is that if the trust just generates tax exempt income or has losses, the beneficiaries might get distributions, right, which absorb just tax-free income, right? Or alternatively, if the trust experienced losses, those losses aren't going to be distributed out. Essentially, the beneficiary is going to have return of principal, right? Tier 4. You just have to make sure historically, is there any undistributed income in tier 1, 2, or 3 from prior years?
And just a second point, I have a note that, says an annuity, this is for a crack, an annuity amount cannot be more than 5% of the fair market value.
Say it again. An annuity amount cannot be more than what?
5% of the fair market value.
It can be. It can't be more than. You can't have an annuity amount in excess of 50%. I think you're missing the 0 there. Other questions? Okay, so let's talk about lead trust. So talked about, and I'm just going to run through some of the things we covered last class. Charitable lead trusts. There's essentially 2 gifts being made at the time a contribution is made. A gift is being made to the charity, right? Because actually it's going to have an interest. And then there's going to be a gift of the remainder interest, right, to the non-charitable beneficiary. Often, how are these designed? Very, very wealthy people set these up so that the actual interest of whatever they contribute is going to be equal to the charitable deduction. So, how do I say this? That the amount of the gift they make to the remainder beneficiary is essentially equal to 0. In other words, actuarially, they can, well, let me put it a different way. They contribute, say, $10 million into a charitable lead trust. The actual interest of the charity is often, and computers do this, they're software programs. I use Number Cruncher. And Number Cruncher will say, do you want the remainder interest to be 0? In fact, I think it defaults to being 0. And then it will tell me exactly what the annuity now needs to be so that the remainder interest is 0. And you hope, or your client hopes, the trust has performance in excess of what's called the 75-20 rate. That's the basis upon which the actuarial computation is made. And the 75-20 rate is something that the IRS announced each month. And I think, V, you looked it up for the month of November.
3.6.
3.6, right? So if you have an investment return in excess of 3.6%, at the end of X years, whatever you make the lead trust to be, if you have an investment return in excess of that, monies can inure tax-free, transfer tax-free to whomever your non-charitable beneficiaries are. All right? So you got to, if your client's not that charitably inclined, but they're really trying to get assets free of transfer tax to their children or grandchildren, this is a potential mechanism to do so.
Quick question. So that's over the 3.6% in that example, correct?
Right, they'd have to, the trust would have to experience over its, whatever the term is, over the, a return in greater than 3.6%.
salary is monthly?
I'm sorry, the rates, but the rate that controls is the date of contribution.
Okay.
So the rates could go up or down subsequent, that doesn't matter. So once you make a contribution, EK, that's it. Meaning, that's your metric, which the trust has to perform by. And when I say it has to, I mean, if it fails and it only gets a 2% return, that just means at the end of the day, your children will get 0. Okay, so be it, presumably you're not setting this up if you're poor, so they'll just get X million from you and not from the trust.
But should the grantor pay tax on their trust income, right?
Okay, but that's a different issue, right, EK? Because you're raising a good point. Now, I'm on page 13. In the first full paragraph, it says, depending on the charitable lead trust terms, okay, it is possible to produce a charitable gift or charitable estate deduction that equals the amount transferred to the trust, resulting in a gift or transfer tax free transfer. In other words, it's possible to zero out the value of the remainder, so there's no gift or estate tax payable on the remainder, interest payable to the non-charitable beneficiary. Goes on to say, in general, the donor is not entitled to an income tax charitable deduction if the transfer is made to a charitable lead trust. An income tax charitable deduction is only available if the charitable lead structure is structured as a grantor trust. And I think this is what you're alluding to, right, EK, that you only get a charitable income tax deduction if it is a grantor trust, okay? And that dovetails with what we were looking at in chapter 4 of our textbook. In other words, you only get an income tax deduction, okay, if you're the donor to this trust, if it is a grantor trust. But there's a big price tag to be paid for that. There's a big price tag to be paid to get this charitable deduction on your income tax return, on your Form 1040. The price tag to be paid is, as a grantor trust, guess what? Going forward, you have to pay all the income taxes on whatever income this trust earns. And guess what? No distributions are being made to you, meaning you or your client, however you set this up. So you better make sure with your client in all bold and whatever else it takes, certified mail. And by the way, ever get letters from clients with certified mail? I haven't gotten one for a while. But 2 days ago, I got a certified letter from a client, which you always have to say, what's driving? Just saying that they needed something taken care of, but I got me a little unnerved because anytime you get but that doesn't stop you from sending a certified letter to your client saying, you better be careful. And by the way, in my case, I think I'm fine. I didn't lose sleep. So there's other times if you get a certified letter, I would be losing sleep. This time, I'm not quite sure why someone wasted their money and couldn't pick up the phone and just ask the question. But anytime you get a certified letter, guys, your antenna really has to go up because you got to wonder, what's going on with the client. Is this the beginning of something that they have in mind? Anyway, but with your clients though, you got to document that they know that they're going to be paying the income tax, right, on these trusts for the next X number of years, right? And that may not, they may think it's a good idea today, but literally 2 or 3 or 4 or 5 years from then, they may have significant misgivings and say, you've never thoroughly explained it to me, all sorts of things. So just make sure that if this is the direction they're choosing to go, that you document it. Now, charitable lead trust, again, we said it could be grantor trust. If it's grantor trust, the donor is gonna, or the grantor is gonna pick up the income. If it's a non-grantor trust, we're just back to our textbook, right? It's normal subchapter J rules, and we have the imposition or the invocation of Code Section 642C. What is Code Section? Just to remind people, 642C is monies going from a trust to a charity, right? Will qualify for the charitable deduction, okay? So if it is a non-grantor trust, as pointed out on the bottom of page 13, okay, and it will just file a normal 1041. Beginning on page 14, again, for exam purposes, Karen, go ahead.
So the year you set it up, you're getting a one bigger charitable deduction for that year because it's the present value of this like bigger lump sum of money, and then it just.
If it's a grantor trust.
If it's a grantor trust, okay. And then just every year you make your, just say, okay, say you put in $1 million, and then every year you make just say 20,000, then you're gonna pay.
Well, be careful, you make, who makes?
Well, the trust, say, makes 20 grand,
That's
so every
important
year.
for you to say.
The donor's gonna, okay, so you're gonna get a bigger upfront deduction on the present value of $1 million just in year one, and then for 20 years out, you're just gonna keep saying you got this income, but you didn't really get it, but it's going to the charity, right? Over the
Karen,
year-
you're going way too quickly.
20 year, okay. No, I'm just trying to think like who would ever do this, but then like, okay, so you do get that bigger deduction up front. And
You
then
get an
probably
upfront deduction, and you
income on
pay
that.
taxes later.
Okay, and then what is this thing on the bottom? Well, to me, it's my page 11, but you're, I put more on per page. About the 50% is the public charity and 30% is not.
That's just limitations. That's under Code Section 170, limitations of what you can deduct annually to a charity. You can't take your income. If you earn $1 million this year, you can't deduct the full 1 million. You can only deduct, I think this year, 2018, guys, correct me if I'm wrong, you can deduct up to 60%, right? Congress changed that?
No, AGI.
Up to 60% of your AGI? Yes, no?
Yeah, 60%.
I think under the 2017 Act, it raised it to 60%.
Yeah, but then you said just before that, you can't take any deduction in every year after that.
That's true. If it's, you only get an upfront deduction in the actual value inuring to the charity.
And then every year you just take the income in.
Yes.
And then so who cares about then the 30% or 50%?
You don't. You only care about it in year one.
Oh, so even in year one, you
Oh, yeah.
can't get the whole actuarial deduction?
You may not.
Oh, God. So
And there's a 5-year carry forward under Code Section 170F.
Oh, okay, all right, I have to write that down.
That answered my question.
I didn't get it. I didn't get that.
All right?
Okay.
And again, charitable leave trusts are not for the faint of heart, okay? And they are not regulated, in my experience, and I do think I've seen a fair amount. Charitable remainder trust, yes. Charitable leave trust, not so much, right? Because, again, not too many people are going to be gung-ho about this notion of, and even as a grantor trust, if you die during the term, there's a recapture provision. So if you've got a charitable deduction in excess of what you, and we're going to go through an example of this, you're going to have to recapture part of your charitable deduction. And this is spelled out on page 15, there's an example. How to make it into a grantor trust? Page 16 talks about the common mechanisms to make it into a grantor trust. These are things we spoke about. The one that a lot of people opt for is the so-called substitution power. That's section 675-4C. 675-4C. The power to substitute if you want to make it into a grantor trust. Then we go into a discussion of non-grantor trusts. And like we said, subject just to the normal subchapter J rules. And at the end of the chapter, list all the revenue procedures which have all the different formats of different charitable trusts. Again, for exam purposes, guys, I just want you to have a general idea, if you could, there's two major kinds of charitable trusts, remainder, lead, and then there's under each, there's annuity, uni, annuity, uni, and then take it down a little bit more, and we're good. I mean, I don't need you to be connoisseurs of charitable trust, but something where you're comfortable articulating what the dynamics, how the beneficiaries are generally taxed. That will work for me, and I hope, again, when you leave this course, it's not just for exam purposes that you take this information with you and you can converse with people. And when issues come up in your office, at least you know what the general forest looks like. So you don't have, shock when someone, or you don't turn white or ashen if someone starts talking about charitable trust. Okay. All right, Simone.
Do you recommend like a reference guide for just practice?
I mean, I like when you
Besides the
say.
Internal Revenue Code?
But if you want, I believe the IRS even has a publication on charitable trust, right? But, this chapter should serve you well. By the way, charitable trust, the law has not changed for close to half a century, since 1969 essentially. So we're going in year 50 now. And I don't see anyone making any overtures to say that it has to change vastly in the future. So, I think I could be wrong, 10, 20, 30 years from now, you heard it here, in the year 2018, you may be dealing with largely the same landscape as exists today. There's nothing where people say, oh my God, I can't believe, like there's some code sections, 1014, in years to come because of budgetary reasons. 1014 is the basis equal to fair market value rule. Simone, I don't know if that's sustainable. Charitable trust, right now, there's no great hemorrhage of revenue from them. People want to set them up, Congress, okay, so be it. There's no political movement that says that they have to be done away with. All right? So, just so you know, we went through some very, the questions here. Hopefully you got the answers. If you didn't, or you're stuck on someone's notes, or you look at the tape that he created, we went through all the answers up through question 6, I believe. So let's just because I do want to get to IRD tonight. So let's just talk in general, because question 6 at the very beginning talks about what is a tiered system. This is question 6A. And we talked about, again, distributions from charitable remainder trust. And we left off, I believe, at question E, right? Your notes, right, for those who were here, for those who watched the tape, left off with question E. It says, in question E relates to question D. In question D, there's a charitable remainder annuity trust that has to distribute an annuity of $10,000 per year, just to remind people. So picture, if you will, you're the beneficiary of a charitable remainder annuity trust, and the trust has to pay $10,000 per year, okay? And distributions are made $6,000 in July and $8,000 the next year, right? In February. What year is Peter taxable? Peter being a cash method taxpayer. So, will his receipt of the cash dictate when he is taxed? And what do you guys recall when it comes to, with respect to trusts in general in subchapter J? If you have a right to income, and the income is paid in a subsequent year, what year are you taxed in? The current year.
Yeah.
Right? Because you have a right to demand that money, right? Similarly, no one's going to fall off your chair if I say, guess what? Peter here is gonna be taxed on $10,000 even if the distributions are not made in a timely fashion, right? Question 7. Briefly explain the estate and gift tax aspects of the charitable remainder trust. And again, for exam purposes, I'm not testing you on gift and estate tax, okay? That's not, this course is not a course on gift and estate tax. But your knowledge goes beyond just course material, because I'm hoping if and when you have an issue in practice, you can deal with this. So with respect to charitable remainder trust, I'll just make an observation or two that both in the gift tax and the estate tax arena, there is a charitable gift tax deduction and there's a charitable estate tax deduction. Monies going to charity qualify under Code Section 2522 for the gift tax deduction and Code Section 2055 for the estate tax deduction. That means, again, the actuarial value when you create a charitable remainder trust, okay, and you contribute $1 million, okay, to a charitable remainder trust, and $600,000 of value goes to your son, and then $400,000 goes to the charity. You're only going to have to file a Form 709, a gift tax return reflecting a value, a gift being made to your son of $600,000. The balance, or $400,000, qualifies for the gift tax charitable deduction. Right? Everyone, that makes sense?
Why does the balance qualify for gift tax deduction? Isn't the balance going to charity?
It is. So that means it doesn't generate any additional gift tax.
Oh, that's good.
So Simone, suppose during your lifetime, you had made a gift to me, thank you, of $11,180,000. So you have no more exemption left. So every dollar you give away now, Simone, generates a tax of 46, right? That's the gift tax rate, okay? And you set up a charitable remainder trust, you $1 million, right? With an annuity flowing to your son, actual value worth $600,000, balance to charity. Well, looks like you made a gift of $1 million, but $400,000 of that gift qualifies for the charitable gift tax deduction. So you only have to pay gift tax on $600,000 times 40%, or write a check for $240,000 gift tax. Right?
I just thought that there would just be a charitable deduction to,
Well, so your son is going to, if things fall into place, he's going to become $600,000 richer, right? And that being the case, you should be paying gift tax on that. All right? Everyone see that? And
but paying gift tax out of the $1 million, I'm just trying to, like, there's 600 and there's 400,000. So
Okay.
the 600.
no. Gift tax you pay out of your back pocket, Simone. You contribute $1 million to the trust, your son will start being paid the annuity. You have to file a Form 709. You separately have to cut a check to the government for $240,000, having nothing to do with the $1 million.
Okay, that's why I was confused. I thought you were saying, he's gonna get the 600 and out of the remainder, which is the 400.
No, not out of the remainder.
Okay, all right.
All right? The source of the gift tax payment is from your back pocket. Right?
That 11 million is lifetime cumulative, like
Yeah,
71.
11,180 is lifetime cumulative. Okay?
Ever gonna win the mega, but.
All right, keep playing the lottery. And upon your demise, Simone, and you had made a gift again, we're going to have you use up your lifetime exclusion because you made a gift to me of $11,180,000. And a day later you die, and you have an estate of $1 million. and you leave it in a charitable remainder trust, where you leave it, same thing, on your death, 600,000, an annuity to your son, and then for his life, and then upon his demise to charity, and let's just say the actuarial value again was 60/40, there would be an estate tax due on the $600,000 value going to your son. All right? What are the tax consequences of transferring an encumbered property to charitable remainder trust? Okay? I mean, again, I don't want to get overly complicated in this context, but in this context, if you're giving property subject to a liability, so if you're giving away property worth $1 million, subject to a $200,000 liability, it's a gift as to its net amount. So the net amount here would be $800,000, right, guys? So if you contribute property, right, worth $1 million, subject to a liability of $200,000. It would be a gift of the net amount, and then you would apply the actuarial tables to the net amount. Question 8. What is a charitable lead trust? And we talked about what is a charitable lead trust, okay? Who is permissible charitable beneficiaries? A charitable lead trust. And it could be any charity described in Code Section 170C, Code Section 2055, that's the estate tax, or 2522, which is the gift tax. So it's one of the three. And essentially, guys, it's any charitable organization can qualify as a charitable beneficiary. And who are the permissible non-charitable beneficiaries? That includes anyone, including the grantor. Okay? With respect to a charitable lead trust, what is the maximum number of years that the income may last? And there is none. The income interest payable to charity it must be for a fixed term of years of any length, or life or lives of persons who are living or created. So unlike the charitable remainder area, where there are strict limitations, okay, can't exceed 20 years for a life. Here there are no restrictions, okay? Again, let me repeat them. There are no restrictions about the maximum number of years or over whose life it's being paid. And with respect to the second question, what is the minimum income payout? There is none. So there is much more flexibility here. What is the difference between a charitable lead trust, annuity trust, or unity trust? And we know that the big difference is one is a fixed amount and one is a fixed percentage. Now in the charitable remainder area, remember that we could have a income only, right, Dane? But that's not true here, right, Shane? In the charitable lead trust area, there is no such thing. Okay? There is no such thing as income only. Is a current income tax deduction allowed for an inter vivos charitable lead trust? And can you get an income tax deduction for a charitable lead trust? And when I say an income, a charitable income tax deduction, and you guys know the answer, you can if, what?
There's no you.
I'm sorry?
No. Charitable lead trust gets the deduction
If, fill in the blank,
if it is grantor.
if it's a grantor trust,
Okay.
right? What's my authority to put section 170 F2B? I'll repeat, put section 170 F2B. We know a charitable remainder trust is not a taxable entity. Everyone agree? Not a taxable entity. except when it has unrelated business income. That's not true with a charitable lead trust. Well, you can bifurcate your answer here. If it's a grantor trust, then the lead trust is not taxable. If it's a non-grantor trust, the normal rules of subchapter J apply, right? During Roger's life, he creates a 10-year charitable lead trust and is permitted current income tax deduction. That is because it's an income tax. It's a grantor trust. Years 1 through 5, Roger includes, so we got the actuarial value, right, of the interest passing to charity, and he includes the income in his gross, he has to include the trust income in his gross income. In year 6, sadly, Roger dies. What are the tax consequences? And this is the point I was making before. There's a recapture provision. So on his final income tax return, he has to recapture the difference between the amount of the original charitable deduction. Let's suppose he got a charitable deduction, say, of $100,000. And to the extent it exceeds the discounted value of the trust income that was included by the grantor in income, but was actually paid to the designated charity. So let me repeat that. You have to take the original charitable deduction to the extent it exceeds the discounted value of the trust income that was included by the grantor in income, but actually paid to the designated charities. And suppose the discounted value of the trust income was $40,000. So originally he took a $100,000 deduction. And now when you look at the discounted value of the trust income that he has included, it's $40,000. That difference, or $60,000, on his final Form 1040, he has to include it in income. So again, clients who opt for the grantor trust status, it could be dangerous territory. All right? And there's a more detailed example, if you go back to in the material in the chapter. On the exam, needless to say, I'm not going to ask anyone what is the recapture amount, okay? But just know that there's these pitfalls. In year 7, suppose Roger wanted the charitable lead trust to invest in tax-free municipal bonds. Is that permissible? Sure. Okay? The trustee can invest in whatever. There just can't be a provision in the trust document that mandates the trustee to invest in tax-free bonds. What is a zero-out charitable lead trust? We already said what it is. It's where the remainder interest, the actual value of the remainder interest is 0. So whatever you contribute, or whatever the donor contributes, the actual value passing to the charity is equal to whatever the donor contributes, so the remainder interest is equal to 0. And to get to the point is, if the trustee is able to command a rate of return greater than the Code Section 7520 rate, then there should be monies left in the coffers of the trust. And there's no revisiting this, meaning once you make a contribution, the IRS, no one can go back and say, oh gee, in retrospect, you have several million passed into the children, you had such a great investment return. It doesn't happen. The consequences, the gift tax consequences, are determined on the day of formation. Does the IRS prescribe sample forms? We know that's yes. And the charitable lead trust allow trustees to choose the charitable beneficiaries on an annual basis? Yes, there's private letter rulings to that effect. Question 13. A creates a charitable lead annuity trust providing for a 20% charitable payout during C's lifetime. Thereafter, the trust assets pass to C's children. C is A's friend, who's 45 years old, who has a debilitating disease that makes it unlikely that he'll live beyond 10 more years. Can C be an acceptable measuring life? All right? So, I just want to quickly pass this out because, again, when it comes to, if, David, let me just, you want to pass this out. There should be 3 here. There's a few here. Why does it pass it behind you? Are there enough? Plenty, can you get it? Everyone's got this? All right, so I just want to call your attention. If you look, there's a regulation, and it's not in your book. If you guys brought with you the Code of Regulations, and it starts, it's page 3 of 11, and then the next page is page 4 of 11. On page 3, the site I'm going to give you is, this is from Regulation 170A-6C2I. That's Regulation 170A-6C2I.
Are there more sheets?
Yeah, there's
We
more.
thought it was just one each.
Yeah, there's just one. It's double-sided.
Oh, no, we didn't
Some of
have.
them are not.
Yeah, some of them are. Yeah.
Oh. Right. All right, there's 2. There's more.
double.
I got it more here. So anyway,
This is double.
Okay, thanks. Just go.
I'm just calling this to your attention. We don't need to ponder this in length. It's not the most important thing. It just, I just wanted to call to your attention that if you look at the bottom of page 3 out of 11, okay, that's where it starts definitions, guaranteed annuity interest, okay, describes what is guaranteed annuity interest. And on the next page, okay, it talks, if you go to line 4, it says the trust will satisfy the requirement that all non-charitable remainder beneficiaries are lineal descendants of the individual who is the measuring life, or that individual spouse. If there is less than a 15% probability that individuals who are not lineal descendants will receive any trust corpus. And in other words, if you read the entirety, beginning on the prior page, reading up here, and again, we don't have the, it says with respect to charitable lead trust, the measuring lives generally must be the donor's spouse, or an individual who, with respect to all remainder beneficiaries, is either a lineal ancestor or spouse of the lineal ancestor of the beneficiaries. In other words, let me get cut to the chase, and you can read this on your own. You can't choose a measuring life of someone who is in bad health, okay? You cannot choose the measuring, and this regulation makes that point, okay? So, it's going to prevent you from choosing a person who's in bad health to prevent abuses. Because you might otherwise choose that person who doesn't have a good actual lifespan and achieve an objective that Congress is not looking for you to achieve. In question 14, it says, suppose the measuring life is the person, the grantor setting it up. If the person setting it up is the measuring life, that is permissible. Okay? And just take a look at this regulation. And even then, if the person who sets it up has some sort of terminal illness, you can't use the code section 7520 tables, okay? You cannot use that for anyone who is terminally ill. This is found in regulation 7520-3B 3I. I'll repeat, regulation 7520-3B 3 1 little y. Okay, that you can't use as a measuring like someone who's in ill health. So your takeaway here, guys, with respect to charitable trusts, identify what they are, identify generally what are the tax consequences associated with the remainder interest and the lead interest. If you have questions as you review the material, let me know. I am not going to get into much depth, but I just want everyone to have a general idea what are charitable trusts. Any questions on the material? All right, so let's have some fun with IRD, and you may, hopefully you brought the code with you. And you can look at code section 691, right? At least have it open. And just so you don't get too anxious, that once we're done reading the material and the questions, just to make sure everyone's on top of the game and that you don't say, gee, it's 8:30 and we're already done. I have a whole set of more questions just to make sure you guys are really on top of the game. So we'll go through these too so that hopefully everyone has a good handle on this. I may have handed out too many.
Here.
So B, if you want to. Karen, if you can walk those across. Everyone have a copy? So, thank you. If you had gone through chapter 6 of our textbook, you know how many questions, thank you, our authors have? One question, so I don't think that would do it justice. So, maybe I have too many, but I think it's a good idea to make sure everyone's comfortable with the material. So, let's talk in general about chapter 8, and let me highlight those things that I think are important here. So, the general rule, 691A, the amount of all items of gross income in respect of the decedent which are not properly includable in respect of the taxable period in which falls the date of his death or a prior period shall be included in the gross income taxable year when received of, and it lists 3 different possibilities of who can be the recipient. Okay? It's a right to receive, right to receive. It's not the actual receipt, it's a right to receive is IRD. Okay? Congressional motivation, we're all familiar with Code Section 61, right? That accretions to wealth generally are subject to tax. And the thing that many people, my experience, both practitioners and clients, many practitioners or clients are used to Code Section 1014, right? Basis equal to fair market value rule. And many people, again, clients and practitioners, are in the assumption that Code Section 1014 is universal, that 1014 applies to all property, erasing all taxable gains and debt. But if you were to keep your fingers on Code Section 691, and you were to look at Code Section 1014, okay, and you look at 1014C, and it says 1014C, this section shall not apply to property which constitutes a right to receive an item of income in respect of decedent under Code Section, under Section 691. All right, so Code Section 1014 makes clear that it does not apply to items of IRD. Everyone clear on that? So the basis equal to fair market value rule does not apply in those circumstances. It's critical, because again, many people under a misimpression that it does. And just for clarity's sake, because often you'll hear people say this, and I just wanted to debunk this up front. When does the basis equal to fair market value rule apply? What is the controlling date? So, say again, David?
Date of death.
Date of death, okay? And then you will hear sometimes people will say the so-called alternate valuation date, right? When is the alternate valuation date? 6 months later, right? So, why did Congress have an alternate valuation date? Well, in yesteryear, when the estate tax were steep, and say someone died owning your Bill Gates and you own Microsoft, and he dies, and the day he dies it's worth $1,000 per share, and there's a fallout in the market 4 months later, and instead of being worth $1,000, Bill Gates dies, the value drops to $200 per share. Well, you don't want someone to have to pay estate tax, right, on something which is worth literally 20% of what it was at the date of death. Hence, and the alternate valuation date came in around the time right after the Depression hit, right? Because people had very high net worth portfolios, and after the Depression hit, their portfolios dropped precipitously, right? But my point in raising this with you is, will the alternate valuation date apply much in the year 2018 and going forward? Does 1014 apply a lot in the year 2018 and going forward? The answer to that question is absolutely, right? Because unless you guys tell me something I don't know, unfortunately people die, right? So the demographics are the same, right? That people are going to continue to die even after the Tax Act passed, right? All right. But, so you might think, gee, people die and then, you know, they get the recipients get a basis equal to fair market value, or they might choose to use the alternate valuation date, right? Or would that apply? And the answer is, the alternate valuation date never, ever applies unless there's an estate tax due. Okay? So you can't use the alternate valuation date to get a higher tax basis. All right? So if your client says, gee, when my father died, the stock was worth $1,000, but 6 months later it's worth $1,500, and they use the $1,500 because the alternate valuation date. And the answer is no. Parenthetically, maybe yes, if that was, if there was an estate tax due. So I just want to make sure everyone knows that, because you'll have that question come up, I can promise you, in practice. All right. So we offer in the textbook debate 2 examples of when Code Section 1014 applies versus when 691 applies. So they vie for they vie for application. So we pointed out on the next page, 1014C, that it just doesn't apply to items of IRD. Okay, 1014C, that it does not apply to items of IRD. Okay. And we put in bold, it's the right to receive. The next paragraph, it's the right to receive. And just like there's IRD, income with respect to decedent, if you look at the fourth full paragraph, we devote to items of DRD, deductions with respect to the decedent. Code section 691B, that there are possible deductions that are afforded beneficiaries with respect to the decedent. Just stating the obvious, what is the number one biggest IRD item that most tax, Javier, number one item of IRD most people have?
Like wages, one of them.
Say again?
Wages.
Yeah, can I make an observation?
Yeah.
Most people, is it fair? You guys can disagree with me. Most people when they die are retired. All right, so wages, it can be true, hopefully not for you.
Homes,
IRAs and 401ks.
Yeah, retirement accounts,
retirement.
right? Retirement accounts are probably the biggest item staring people in the face with respect to IRD, right? So I'm not saying you're wrong, Javier, I'm just talking in terms of magnitude. Probably the biggest item is going to be IRD, you know, hopefully you didn't get to be that old, you're not working. All right? We're good? All right. Let's look at the questions. A taxpayer owns Apple stock, appreciated from 100 to 1,000. If the taxpayer dies owning the stock, the taxpayer's estate recognize any income if it sells the Apple stock for $1,000 per share. And your answer, John, is?
Yes.
Tell me.
It's appreciated.
Okay?
No.
Lydia, would you agree? This is question 1 on page 3. Simone, you were going to say?
I was just gonna say, like, what is that basis? Like,
Well, I'm asking you.
I would
Isn't it
say
fair
no,
market
the
value?
basis will be fair market value. So
Right, 1014, right, John? Right, Clay? So the base is equal to fair market value, or the gain is erased, right? This is page 3 of John, the chapter.
Oh.
Right, you may be looking at the wrong thing. All right? Hey, you got that? Is that no or yes?
Because 1014C is not applied.
Well, 1040, this is not income with respect to decedent, right?
Yeah.
Right? There's no right here, the person just dies owning it, okay? They get a basis equal to fair market value of the asset. Question 2, taxpayer is an IRA that has $900,000 which is estate named as the primary beneficiary. Taxpayer dies testate, right? Remember what the word testate means, with a will, as opposed to intestate, without a will. And as the executor withdraws the $900 to pay estate tax, is the $900 taxable? Any answer, Karen? You're shaking your head.
Yes.
Yes. Why?
Yes, no. This is 691.
Say again.
This is 691.
Yeah, 691. This is IRD, right? 691A. It's a right to receiving. What
I have
justification?
a question.
Sure.
Why did you put this thing that they will pay estate expenses?
doesn't matter.
I was wondering, because I was thinking, what, you know,
Can be used to, I mean, they may get a deduction, but it doesn't matter, they have to include it in the income.
okay.
What justification, if any, is there for different results, question 1 and 2? Now, depending on what professor you have standing here, might give you different answers. In my world, I don't know if there's a good justification, because I'm not a big fan, if you could hear my voice, about 10-14. So, I'm not so sure. Remember, why would the person with Apple stock, who guys owning it, that $900, if you guys tell me, I can't think of a good justification why that never gets taxed. And it's pretty inequitable if you have to twist my arm and say so, because who owns the stock and appreciated assets in this world? Because we don't show a six-pack, right? All right, so I'm not sure if there is a justification, but the system has been intact. Since 1921 was when, through truly, if I haven't said this before, it seems like an administrative mistake. Whoever drafted the regulations in 1921 created the basis equal to fair market value rule. That was not even in the code. And then, through administrative error, it was pushed in the regulations, and it's been with us ever since. All right. Defining IRD. The term IRD, the regulations spell out, refers to those amounts which the decedent was entitled as gross income, but which were not properly includable in computing his taxable income the tax year ending on the date of his death or previous year in the method of accounting employed by the decedent. And what we try to do in this chapter is outline the main categories of IRD. What are the main categories of IRD? Okay? And they come in essentially four flavors. Compensation, investment income, sales, and miscellaneous. And catch-all. So, Javier, you were mentioning wages. That's a biggie. Okay? And the controversies that have arisen really have focused on bonuses. To bonuses, right? I think we're all pretty clear, right, that wages that are owing to you are going to be IRD, right? That's a right, it's not an asset, right? So it's not going to get 1014 treatment. But what are bonuses? And particularly if that bonus, you're entitled, you have a right to wages, right? You have a right to pound the desk or your beneficiaries, give me, whatever my spouse earned. But bonuses are discretionary, right? So they don't seem to fit comfortably within the scope necessarily of Code Section 691, which is an actual rate. But if you read some of the indented language that we've cut and pasted from these cases, then you will see that the courts have been reading IRD pretty broadly. If you look at the italicized language, is not necessarily a legally enforceable right, but merely any right derived through his services rendered while living. So it's been very broadly construed.
Question.
Pick it up.
What if your bonus is like a guaranteed percentage?
Well, again, that's easier. Okay, that should be IRD because you really have created a right if it's guaranteed percentage. The harder case is when it's not guaranteed. But the courts have been pretty liberal in construing IRD or expansive, right, in the scope. Right? So you can read these for yourself. There's several cases. They keep under the concept of stare decisis. Excuse me, they refer to earlier cases, including This O'Daniel's estate. They all seem to go for the commissioner's favor, okay? So there's several different cases. They're pretty straightforward, guys. I like to think, maybe I'm wrong, maybe I'm biased. Well, not maybe, I'm sure I'm biased. That if you read this chapter, it's not a hard read. It's less opaque than our textbook. Hopefully you share that opinion. That was my motivation to try to put together this new textbook. Try to read this. If you get stuck, let me know. But I do think the excerpts we have, instead of pondering the entirety of the case, that you can, hopefully follow. But you be the judge. By the way, as you go through the 2 chapters I distributed, if you have any thoughts in general, this book is still a work in process. So please let me know if there's anything that jumps off the page. We still haven't had the professional editors, so I see typos galore, but we'll hopefully get to all that. Anyway, in the interest of time, if you go to page 9, it says definition of IRD in the compensation area. It includes wages, compensation, and these are the bullet points, or other benefits payable to the decedent attributable to his or her services over which the decedent has a legal right to enforce such payments. Is post-death bonuses, okay, in which there's substantial certainty. Okay, it doesn't have to be, Carlo, doesn't have to be guaranteed. And it's post-death payments to payable to a third party attributable to decedent services and labor. Okay, so you can look through this yourself. I think it's pretty straightforward. With respect to investment income, the real issue is, did the decedent own the property that gave rise to the income? Did the decedent own the property that gave rise to the income? And if so, did he have a legal right to the income that was generated? Okay? So investment income, things that you would anticipate. Interest income, dividends, rent, royalties, all fit. And then being IRD, potentially. How about sales? Okay, how about sales? Now here's the interesting thing about a sale. In most people would prefer that the sale didn't happen. What do I mean by that? The decedent, had he or she been alive, would have preferred that the sale didn't go through, because had they died without the sale going through, Code Section 1014 would apply, right? So let's pause and think for a moment. Sadly, you're about to die, and you're engaged in a sales transaction. In your perfect world, you would pull the plug on the sale and say, you know what? Deal's over, I'm dying, I'm not going through with this. And if you could, like, reverse time or do what I'm saying, knowing that sadly you were gonna die, you would prefer the application of Code Section 1014, right? And the problem is, if the sale has gone through, what have you created? You created an item of IRD, right? So what happens sometimes is it's right at the moment, right? Maybe the deal was so good it killed you, or so bad you're like, I can't believe I sold the business I worked my whole life. You're out of here, all right? So it's at that moment, like right at the moment, and the question the courts have had to address. Now, clearly, if I was selling my business, but I was just scratching my chin, and I really hadn't made all the, we hadn't signed the contract or anything, and clearly I would die owning the property, and 1014 would apply. And the converse is true. At the other end of the spectrum, if I had sold the property and installment payments started being made, well, that's IRD, and 1014 is not going to apply to the installment obligation, right? But there are certain instances, right, that just happen right at the moment of truth, And the question is, where along that continuum, you know, is it? And obviously there's gonna be some really tough decisions. And typically, if there's material things that still must be done, then 1014 would apply. But if the only things that need to be done to complete the deal are what are called ministerial in nature, then 691 applies. So let me repeat that. Is that if there's anything that remains of substance that needs to be done, that the deal will be considered incomplete and 1014 will apply. Conversely, if there's only ministerial, items of ministerial or ministerial in nature that need to be accomplished, then 691 will apply. All right? And you can read the material here, and it outlines, you know, where along that continuum it is. And again, these are challenging cases. These are not black and white, you know, binary, easy to tell cases. I don't know if you'll agree, on page 13, the first full paragraph there, I think it's nicely said, but you can be the judge. Page 13, the first full paragraph, 5 or 7 or 8 lines down. Bearing this precept in mind, IRD in the sales area should exist whenever the following exists. The decedent has so changed his or her position with respect to the property that it may be said he or she can no longer owns the property in question, but rather owns the right to proceeds arising from the disposition of property. This can be said to have happened when a binding contract, not merely substantial authority, certainty, not merely substantial certainty for the sale of an item exists, and all material matters concerning the sale have occurred prior to the decedent's death. At the decedent's death, there are no economically material contingencies, and the object of the sale was in a deliverable state. All right? And then there's miscellaneous items of IRD. And we end with a summary that just says the term IRD is not susceptible to an easy definition. Any definition must be less than enough to permit the regime to accomplish its goal. So this gives a little bit of, flushes out the details of what is IRD. Let's do this, guys. If you can, and I apologize, but I want to make sure we get through this. Let's take a short 6-minute break, don't go vanity. And let's come back and let's finish this up, and then I want to quickly go through the problems I handed out so that we all have a good command of this, okay? So looking at the clock, if you don't mind keeping it to a shorter break, that'd be great.